So these are my some of my rules for picking up stocks. I've done one similarly a few days ago. So what are the rules? So first rule is absolutely no doubt the company which I buy has to be top quality. I do a lot of research before I touch the company. And I will have a very clear rule that companies like Vedanta, where I don't like the management, I would still buy it knowing fully well that there is a buyback coming at maybe 140 and therefore it is not a bad buy at 90, right? So these kind of things, but largely would I buy a Vedanta and sit on it for 2 years, 3 years, 5 years, 100 years? The answer is no, I will not. I would rather go for an Asian Paints, Burger Paints, HDFC Bank, HDFC Limited, which have really proven that they are high quality. You have a choice of between buying high quality and low quality. Always go for high quality. Low quality can be a short-term call, and immediately you might, I mean, somebody could tell you Arcom is a good buy at 2 rupees 5 paisa. It is definitely a good buy at 2 rupees 5 paisa, provided you have a very strict stop loss of 2 rupees. Because how much you should lose in a shit script like this is only 5 paisa, right? Sorry, I'm joking, but yeah, don't buy these kind of stuff. You are more likely to lose money than make money. So first, quality. And for me, if I'm investing in it, it has to be a dividend paying company. So all these companies going to NCLT and all don't attract me. I may still buy a 5,000 shares, but then that 5,000 into 2 rupees doesn't hurt me at all, or maybe even 20,000 shares. 40,000 doesn't hurt me at all. But for a small investor starting to invest, trying to make dividends his mainstay for his retirement, the quality rule is very important, and it is the most often overlooked rule, because they will want something जो अरे 2 रुपये का चीज़ दो जो 4 रुपये हो जाएगा, 2 रुपये वाला 1 रुपया होने का chances ज़्यादा है. So buy a good quality stock. Obviously you will not get them very cheap, but then over a period of time they will start looking very, very inexpensive when you bought it. Please understand the difference between inexpensive and cheap. Wait for good prices to buy. That is the rule number 2. Don't be in a hurry. Identify your portfolio. Make your portfolio like a fiction, right? You make your portfolio somewhere and keep it and say, okay, these are the 22 shares that I want to own in my life. As of now, I may revise it later on, and I will keep on seeing when I get it at the price at which I want to buy it. I may sometimes get it, sometimes I may not get it. I'm sure by waiting you will get it. Yesterday, for example, Coromandel International came down, and I somehow thought that it will come down to 750. So I could buy it 750 because in the morning itself we had put a buy order at 750, and at the end of the day we had sold it off at 800. So it's not that I tried to trade in it. I was happy buying it at 750 and keeping, knowing fully well that I'll be able to sell it off for 850. But in the same day, if I could get a bargain, I take the bargain, right? So price you have to pay for your portfolio. Some days you get value, some days you get deep value, some days you get deep value. Like look at what is happening to Prashant Jain's portfolio, or even some parts of Naren's portfolio. Deep value to deep value, right? So you will need time and patience for making money on those portfolios. Nothing right, wrong. It's just a matter of strategy. Which brings us to the third rule, that try to see that the company has a big moat and has a margin of safety. In this, I think ITC scores like anything, because in the cigarette business it's a huge moat. A new guy can't come in and a guy can't advertise. So it's like, you know, if there was no advertising possible, LIC wouldn't have lost any market share. So some advertising, some aggressive selling, some giving huge margins to the intermediary, all those techniques have been used for LIC to slowly reduce its market share. It's been whittling away like a rat gnawing at it. It's slowly losing market share. Nothing can happen like that in ITC. People will continue to smoke and kill themselves. Wrong example for me to give, because I don't like to invest in this cancer spreader. I used to be an investor long ago, but no longer an investor. So to that extent, caveat, I don't own ITC. I may be owning ITC in some form, because some of the mutual fund or ULIP that I hold may be holding ITC. I have honestly not done a study of that, but otherwise directly I don't own any ITC or any other cigarette or spirits company. I just don't. I mean, it's a matter of choice, right?